Hello, everyone. Welcome to the CAGP Foundation's free fall webinar. My name is Erin Kuhn. I am the Manager, Education and Training at CAGP. I'm very excited to welcome Joanne Ryan, Vice President, Philanthropy at TD Wealth, presenting charitable giving strategies for high net worth donors, sliced and diced by profession. Just before I turn things over to Joanne, I just wanted to mention a few things. Please submit your questions anytime in the question box on the right-hand side of your screen. Joanne will take some time throughout the webinar to respond to your questions. Her email address is included in the presentation as you see there, so if she does not get to your question today, you're welcome to email her afterward. This webinar is worth 1 CFRE credit, and as with all of our webinars, today's presentation will be recorded and you will be receiving an email with a link to the recording. As a reminder, when I sent out the login information email to you, it contained a link to a Dropbox folder with PDFs of the presentation, along with Joanne's bio and a CFRE tracker sheet. Thank you so much for being here today, Joanne. I will let you take it from here.
Good. Welcome, everybody, and thanks for joining us. Perfect time of year. It's the giving season to be discussing strategies with high net worth donors. And today's session might be just a little bit different than some of the other sessions. What we're going to take a look at is different professions, whether you're an engineer or whether you're a doctor, whether you're a salaried employee or an executive at a bank or a publicly traded company, whether you're retired, we're going to take a look at how you hold your assets, and based on how you hold your assets, what would be the most appropriate charitable giving strategy that you might want to consider. So it's definitely not one size fits all when you're talking to a high net worth client. It definitely depends a lot based on their profession and how their assets are held. So before we get into it, I'll just share a couple of high-level trends that I'm seeing in philanthropy overall. I think there's a lot of positive trends around philanthropy. Certainly, we've been doing a lot of research on women in philanthropy over the last several years, and women are growing in wealth. By 2026, they're going to own half of the wealth in Canada, and in 2016, they owned about 35% of that. Women are growing in entrepreneurship. Their life expectancy is greater than men. They often inherit twice from parents and then again from a spouse. We're seeing a growth in new Canadians and their giving. A lot of immigrants very grateful to Canada, have become very successful and also want to give back. As we're doing estate planning with our clients, 20 years ago they would probably say everything to my kids, and now they're basically saying my kids are not getting it all. It's just way too much. The Warren Buffett phrase, you want to leave your kids enough to do anything, but not too much to do nothing. And so philanthropy almost becomes a child for these people also. And the other thing that we're seeing today, another trend, is the makeup of the high net worth client in Canada. 20 years ago, there was a good chance it was family money, and today, this is a stat from Investor Economics, is that 2/3 of high net worth clients are self-made. So what does that mean when it comes to their giving? Well, people that inherit money give back, but they also view their role as a steward or custodian of those assets to pass on to the next generation. If you've made it yourself, like 2/3 of Canadians, then it's your money. You made it. You can do whatever you want with it. And especially as we speak to business owners who have built a successful business in a particular community, they're very grateful to that community that helped them to acquire their wealth. And so when that business is sold and they're in a position to give back, they very much want to support the community that helped to support them as well. So lots of different ways to look at giving, depending on who you actually are talking to. So let's talk about executives. So I'm talking about executives of publicly traded companies. We deal with a lot of those. They accumulate a lot of wealth, very significant portfolios. They're often compensated with stock of their companies, and they're also compensated with stock options. Many are community-minded, but very, very busy, and they're not necessarily aware of all of the rules related to charitable giving, the tax rules about stock options. And I mean, I would even say that executives at TD Bank, even though I deal with executives at public companies across the country, the TD Bank executives are not aware of the rules. It's just not something that they're focused on. So there's a big opportunity to educate them. And so when you end up with a large concentration of stock, obviously most people on the phone here probably know when you donate stock, you get the tax receipt and you eliminate the capital gains tax. But sometimes these positions are so large, and so then when you look at this executive and you say, you should consider donating this, you've really accumulated, you're not diversified, there's a large capital gain, they are often hesitant, especially if they're still, married to that company, because they think there's still going to be upside potential for that stock. And so what we encourage them to do in that situation is to make the donation of the appreciated securities, get that donation receipt, eliminate the capital gains, and then you can buy that stock immediately back with other money if you love it so much, and then you've just stepped up your cost to the new market value. So it's a good, it's a good strategy, and a lot of our executives will do that. They want a market time when to make the donation, when the stock is trading at its all-time high, but we all know that market timing is difficult for everybody. But the last point on this slide, really, I think the strategy that works well when somebody has a very large concentrated position, you suggest they make the donation of stock, they look at you like you're crazy because that's way too much, is we work with their advisors to calculate how much would they need to donate, assuming that the balance is sold so there's zero tax to pay. And that's a great strategy for a lot. And then the investment advisor gets to start managing a much more diversified portfolio for them. So back to stock options. Stock options, as I said, a lot of executives are compensated with stock options. So when you exercise a stock option, the difference between the exercise price and the market value is taxable. It's taxed at the same rate as a capital gain, but it's treated as income. So what does that mean? It just means you can't offset a capital loss against it. And the rules for stock options are that when you exercise stock options, if you want to eliminate that tax, you actually have to donate either the stock or the proceeds of the sale within 30 days and in the same calendar year. So there were, in the last budget, they did propose some changes to the stock option rules. We're still not sure what's going to happen, given that the Liberals have a minority government. However, even if they do change, all of the existing stock options for the last number of years are going to be grandfathered. So this is still really important, because even if that change does go through, which we don't know, this is really important because there still will be a lot of people with stock options that will fall into this situation. And then I like stock options better than stock, because people sit on stock forever and forever and forever. But what happens with stock options is they get to a point where they're going to expire. So now there's a deadline, and the executive has to exercise them. And now that they've exercised them, they can't sit around and wait and think for years, because they have 30 days to decide if they're going to make that donation. And I have worked also successfully with executives to not have their employer not withdraw tax, especially if it's earlier in the year when they're exercising it and they don't want to wait until like the following year in April when they do their taxes to get the tax back. So CRA's position is that the employer doesn't have to withhold tax if the executive is exercising and donating. So a lot of our clients will hold. A lot of our clients are going to hold funds in their corporations. If we just talk about doctors and dentists, but this could be other people. And these are just using Ontario rates, but you can see that corporate tax rates are lower than personal marginal tax rates, and money can be withdrawn and taxed at a lower rate. And there's also some opportunity for some income splitting. So dentists, when they retire, will typically sell their practice, and there's a lifetime capital gains exemption of $866,000 in Ontario. And to qualify for this exemption, 90% of the company's assets have to be used in an active business in Canada at the time of the sale, plus 50% of the assets during the last 24 months. So if funds are just simply sitting in their corporation as passive investments, they won't qualify for that investment. So they typically set up a holdco, a holding company. They loan their money to their holding company to buy investments. And it's also not only another reason people do that is creditor proofing. And it's just a great, creditor proofing as well as to qualify for that big capital gains exemption. Doctors don't generally sell their practice because we have a doctor shortage in this country. So they mostly hold cash in their professional corp, but some will set up a holdco again for creditor proofing reasons. So when we look at high net worth clients like that, they end up with a lot of money in corporations. And, we've talked, individuals make a donation, they get a tax receipt, they get a tax credit, and the tax credit reduces taxes payable. So when money is being donated from a corporation to a registered charity, you get the donation receipt and you get the deduction. So it's a deduction from income in the corporation based on that corporation's tax rate. Corporations have the same limits that individuals have. The corporation can donate up to 75% of the corporation's net income, and any excess can be carried forward for 5 years. So similar limits as individuals. And if that corporation has publicly traded securities that have appreciated in value and they donate those securities to charity, again, they'll get the tax receipt for the market value, they'll get the deduction. But what becomes interesting here is that the full capital gain that they've just eliminated, and we're going to look at an example, gets credited to the corporation's capital dividend account, which we call the CDA. And the CDA is not a real bank account. It's not reflected on your financials. But whatever you can accumulate in the CDA, you can withdraw as a tax-free dividend. And so great opportunity to donate appreciated securities through a corporation. So if we look at a simple example, let's assume the corporation has securities with a value of $100,000 and the cost of the securities is $20,000. So win number one, they donate $100,000 of securities to charity and they get a donation receipt for $100,000. Win number two, they eliminate that whole $80,000 in capital gains. And then the win number three is that full $80,000 gets credited to the corporation's capital dividend account, allowing for them to withdraw $80,000 in other money on a tax-free basis. Now, assuming they didn't make this donation, or they didn't do this tax-free withdrawal, they just kept this money, this $100,000 in their corporation. When they die, when the shareholder dies, there's a deemed disposition of the shares of the corporation, and the estate is going to have to pay tax. So what has happened here is they're actually also saving estate taxes because they've shrunk the size of the corporation by $180,000, $100,000 for the donation and $80,000 for the tax-free withdrawal. So it's reduced the value of the corporation, and therefore they're also saving estate taxes. So if they sold a security if you sell a security in a corporation, 50% of the gain is taxable and 50% goes into the CDA. And then if you donate, then it's the non-taxable portion. So because there's no tax on capital gains for donating securities, it's that entire $80,000. So what we find is that people with holdcos, they don't know They don't know these rules. Their accountants aren't giving them proactive advice around it. And we find that a lot of accountants will set up holdcos for clients as a way to defer tax, but they don't really do any planning with them in order to figure out how to get money out of the holdco as tax efficiently as possible. So what I say, certainly at TD to our advisors, is that if you have a client with a holdco, you should ask them what planning they've done to get the funds out of the holdco as tax efficiently as possible, and there's probably a blank stare at that point. If they, if they're philanthropic and if they have appreciated securities, this is a great opportunity. And the other thing is they can do here is if they took the tax savings from the gift and bought life insurance that was owned in the holdco, say it was $1 million policy or $1 million death benefit, majority of that $1 million upon death is going to flow into the capital dividend account and tax-free to the estate or to other shareholders. So there's an opportunity to also include insurance strategies with clients that have holdcos. So same with business owners, great opportunity for donations when they sell their business. And we work with a lot of business owners, and a lot of them will also have holdcos. A lot of business owners will set up donor advised funds and foundations, which we'll talk about at the end. And actually, the business owner once said to me that, they give generously in years when their business does well, but in years when their business doesn't do well, they don't have any money to give to charity. So they like to set up donor advised funds and start, putting money in whenever they can, because they know the charities will come asking every year, and then regardless of the volatility of their business, they'll have money in their donor advised funds to actually to give to charities. So are there any questions at this point?
No, we don't have any questions just yet, Joanne.
Okay, thank you. So I apologize if there's any lawyers on the phone, but this is actually, the next slide is actually feedback that I got from a number of lawyers who we've talked to about their charitable giving. So they're allowed to incorporate. Most lawyers in large firms do not incorporate. They tell me themselves that many like to spend. And so a limited incentive to defer taxes. For ones that are savers, they might set up a PC. And for firms that are set up as partnerships on the admin side, they have to amend agreements to accommodate for PCs. Private practice lawyers, it's easier to incorporate, and then similar to dentists, if a lawyer in a private practice has a client base, they'll probably sell that practice, and they need to keep the company clean to get that capital gains exemption, and also have creditor proof. But this is actually quite funny because the shoemaker's kids have no shoes. And apparently many lawyers, even the ones that are sitting drafting wills all day, don't have wills themselves. They put their clients' needs ahead of their own, and often don't have wills. So an opportunity to get lawyers to get their act together also. So lots of retirees, and this is a trend that I'm seeing, people are accumulating very, very large RSPs. And in the year that they turn 71, they have to convert it to a RIF, and then they're forced to make mandated withdrawals from the RIF. And of course, they're taxed on it, and then their OAS is clawed back, and they become very cranky about this. But they've never really needed, they've never needed that money that's been sitting in their registered plan anyway. So I'm seeing a real trend in terms of people with RIFs to donate the RIF payment to charity, and in most cases the donation is going to offset the tax owed on the RIF, and it's kind of turning something that that bugs them into, or negative, into something that is more positive. So we also meet, as we do estate planning with our clients, lots of people will leave a very significant bequest to a charity in your will. But what they aren't aware of is that they're not aware that there are limits in terms of what you're able to claim in the year of death and in the year preceding death. So you can claim, donations in the year of death up to 100% of your net income, and you can, carry it back 1 year and claim it in the year preceding death. There's also some new rules that came into effect January 1st, 2016 that provide some other flexibility provided the gift is made by a graduated estate to claim it in the taxation year of the estate when it was made, any earlier taxation year of the estate, and then the last 2 taxation years prior to death. So there's a bit more flexibility, but what we find is people are leaving large bequests in wills to charity, and they're wasting tax credits because they just aren't going to have enough income to be able to claim it. So, we talk to those clients about considering accelerating some of this giving during their lifetime in order to maximize the tax benefits and minimize what CRA gets. But also, we also point out the benefits of giving during your lifetime and engaging with the charity and seeing the impact of your gift as opposed to wasting that tax credit. So this was just a simple example here where net income is $200,000, and you can see a bequest to the charity for $1 million, and you don't know what month somebody is going to die in. They could be unlucky and die in January and have almost no income in the year of death. But assume they've timed it perfectly and they die on December 31st. Even then, the maximum amount that would be claimed on this $1 million gift is $400,000, which is the income in the year of death and the income in the year preceding death. So it makes sense to at least have the conversation about considering to accelerate some of your gifts to charities during your lifetime in order to maximize gifts to families and to friends. And it's a good conversation to have. So engineers, there's really absolutely nothing magical about engineers, but they're very analytical. And I brace myself when I know I'm going to meet an engineer. And so I find with these people, they need to see the numbers on paper. Even though I can look at somebody's net worth and I can look at their income, and I know instantly that they have more money than they're ever going to need during their lifetime, they actually need to see on paper the impact of your gift. So we do comprehensive financial plans for clients at TD, and for some people like engineers, they actually have to go through that process in order to understand the impact, the financial impact of making that gift. And then once they do, they will step up and they will give. So when we're looking at this is kind of a summary. When we're looking at philanthropy prospects and their holdings, obviously anybody who has publicly traded securities that they own personally, a great prospect, but then there are extra benefits with the CDA and the CDA withdrawal for appreciated publicly traded securities that are owned in a corporation. We talked about large RIF, and they don't need the money from the RIF, so donating the RIF payment is a great opportunity to mitigate the tax. Any money in motion, really. So I've worked with a number of people where they own shares of a public company that is going to be taken over, and especially if it's going to be an all-cash deal, because if they just sit there and they do nothing, then they're basically going to have a big tax bill. And we can even look at the WestJet, just the WestJet deal. A lot of people have WestJet shares, and that's something that was important to have discussions and have people understand the impact of what's going to happen when that sale is done, and basically what planning opportunity there is. So we talked about clients. We're seeing a trend with clients that have no children. So philanthropy becomes a child, basically. We're seeing basically clients have children, but either they don't want to leave them their money because it's too much, or it's not uncommon now for our clients to just start bragging about how successful their children are and they don't need the money. And so there's a great opportunity to do some planning. And we find, well, obviously we have a lot of donor advised funds that are set up in memory of somebody, so it's not necessarily tax driven. Somebody has passed away and they want to set up a fund in memory of somebody to keep their name alive and to keep giving to things that were very important to them. And so donor advised funds can also be a really, really great opportunity. And then, we're just finding that today our clients want to unite the family around shared values. And whether it's the family values or whether it's even allowing each adult child to go research a charity and come back with a recommendation and have a family discussion about what they're supporting, then it's something that we're finding is happening more and more. We're finding that families are wanting to involve multiple generations in their giving, and so we're having discussions with lots of different generations who have, of course, all kinds of different ideas also. Any money in motion. So we have actually, it could be the sale of a business is an obvious one where we get very, very much involved, and the person typically wants to mitigate the tax on the sale of the business. Donor advised funds, and I'm a big fan of that, but really my role at TD is to work with our clients and their advisors to incorporate philanthropy as part of financial and estate plans. Donor advised funds are one option. We do a lot of work, though, just helping somebody, helping people to give in a way that makes sense for their personal situation, which could be a donor advised fund. It could be just, a bequest, a life insurance, an outright gift to a charity. So when somebody is selling a business, it's usually a pretty stressful time. The business owner is usually very, very involved in the transaction. They often want to make a significant donation to offset the tax on the sale of the business. They're not in any mindset to sit and figure out what charities they're going to give to. And so being able to put money in a donor advised fund by a certain date, so they can, they can get that donation receipt. Then when they come up for air, they can thoughtfully plan what that legacy is going to look like, is something that we do a lot with business owners. So often we do that, and donor advised funds aren't necessarily endowing, they're not endowments. Ours certainly isn't. We let people distribute capital, but sometimes they just need to park it. They need to get that tax receipt by that certain date and then work on how they're going to distribute it at a later date. We've had lottery winners. We've had people with divorce settlements. We had a couple who they were retired actually, and the husband wanted to keep making a business, making money flipping real estate, and his wife wanted to do some philanthropy, which the husband wasn't interested in, and she divorced him and then took part of the divorce settlement and set up her own donor advised fund. So any money in motion is always an opportunity to have a philanthropy discussion with clients. We're big fans of doing comprehensive financial plans with our clients because often then it becomes clear, as I mentioned, that they will have more money than they're ever going to be able to spend during their lifetime. And once again they see that and they realize that, they can start thinking about philanthropy. And then clients have significant bequests to charities in their will, and they're not going to have income in order to claim them. An opportunity to have that discussion, as I said, about accelerating some of that giving during their lifetime, or any type of tax problem. that a client has is an opportunity to to have those conversations and to have those discussions. So a lot of high net worth clients that I'm going to say that are business owners, that are hands-on engaged, choose to have their own private foundation. And private foundations are the most highly structured form of long-term giving. They've been around for quite a long time, and wealthy families have been setting up private foundations. And I thought it's good to have a chat about them. The donor advised fund is an alternative to setting up your own foundation, but there's still some good reasons why people would want their own foundation. Allows for personal engagement, unites family around a common purpose, an opportunity to leave that legacy. All the tax incentives and benefits that we talked about apply whether you give to a registered charity or a private foundation, and allows donors to fund new projects at a local, national, and international level. So who sets up private foundations? Entrepreneurs, it could be executives, professionals, affluent individuals, but I would say business owners looking for tax relief, people that want that hands-on approach to their philanthropy, greater control over how the money is managed and where grants to charities are directed, and flexibility to change. So greater control, there are rules in terms of how foundations can manage money. They're governed by the Provincial Trustee Act. So they have to be diversified, keep up with inflation, generate income. So I often talk to, a CEO of a public company who wants to set up a foundation, and they want the 100% of the investments to be in the shares of the company that they work for, because in their opinion, there's no better investment. So that's not going to fly, because the foundation owns the assets. So you as an individual can be as conservative or as aggressive with your investment portfolio as you want. But when the money is owned by the foundation, it's not the individuals, and there are rules in terms of what they can do and can't do. So it's usually a lawyer or an accountant, but usually a lawyer that sets up private foundations. They can be set up as a trust with a trustee, or a non-share capital corporation. Regardless of how it is set up, they apply to Canada Revenue Agency, and they get a registered charity number. So you've basically set up a charity once you've set up a foundation. Foundations are tax exempt, but they still have to file that information return with Canada Revenue Agency, which, as you know, is public, and anybody can go in and see it. Disbursement quota for the foundation used to be a nightmare, and it's quite simple. As of 2010, the foundation needs to distribute to charity or use for charitable purposes a minimum of 3.5% of the average value over the past 2 years. And that's just a minimum that can come out of income, capital gains. That's just a minimum. So foundations can do much more if that's what they want to do. So this is really the steps to set up a foundation, a private foundation, and it can take some time, because you are at the mercy of Canada Revenue Agency, and they don't act quickly. One of the things about foundations, though, that people don't realize is they're called private foundations, but they're not private. Because, as you know, once you set up a charity and a foundation is a charity, then all of the financial information on your foundation from your information return is on Canada Revenue Agency's website, and anybody can go and look at it. And so for people that are looking for more privacy, as opposed to being in full view, they need to think about that. And we actually had a client who set up a private foundation for $100 million, and a year later, and he obviously wasn't aware of all these. He actually really was quite upset when he realized that everybody could see what was going on, and it bothered him a little that people would know that he had a private foundation for $100 million, but he was giving to a lot of religious organizations. What bothered him more than that is that organization A would be able to see that he gave more to organization B, and that was very disturbing to him. And so we sat down and we tried to figure out what to do and how do we solve this. And we decided we're not just going to roll the $100 million into the private giving foundation, but what we did do is we did open a donor advised fund for him, and once a year when he's ready to make his grants to his selected charities, he then moves a chunk of money into his donor advised fund with the private giving foundation, and then he gives us a list of charities, and we pay that out. So we pay that out to his selected charities. And so if you look at the information return, for example, of the private giving foundation, you're going to see thousands of checks in thousands of different amounts that are paid out to all kinds of different charities. But you don't know on a fund for fund level who recommended it or who chose it. So it gives you the donor advised fund would give you a little more privacy than having your own private foundation. Any questions at this stage, or should I just keep going?
We do have 4 questions if you'd like to,
sure.
And I can read them to you. Okay, so first question. If a corporation is wishing to make a donation of securities and they're a publicly traded company, are they able to use their own company share? Do own company shares qualify for a favorable tax treatment?
So the examples that we've been giving really are for holding companies, but you're saying a public company owns publicly traded securities. So, and would they be able to make that donation? Is that the question?
I'll just reread it. If a corporation is wishing to make a donation of securities and they are a publicly traded company, are they able to use their own company shares? And then in brackets it says, do own company shares qualify for a favorable tax treatment?
Okay, you know what? Why don't you email me that, and I'm gonna. Sure. I think I need to put a little bit of thought into that rather than just blurting something out, and we can get the answer back. Next question.
What metrics do you use to define high net worth?
So people have different definitions in different companies in terms of what high net worth clients are. I think for this, we're basically saying investable assets over $1 million.
Great. Next question. If donations are made prior to death to prepay the bequest, how does the estate manage the bequest?
So, I would say that if I see a trend in that area where there is a bequest in a will, but then and this is what the university that I'm on the board is doing. Someone has told you they've left a bequest in the will, but then they actually decide they're going to give it to you while you're living, which is actually really good news for the charity. But they typically would have to update their will to exclude the bequest because they've chosen to do it during their lifetime instead. So it doesn't become something that you can start claiming in the estate when they've made it during their lifetime.
Okay, do you want the 4th question?
Sure.
Any comments about angel investors or startup entrepreneurs in terms of their assets or philanthropy?
Well, there's a whole. I just attended the Social Finance Forum at Mars last week, and so there's a whole new type of social entrepreneur. There's a whole trend on impact investing, which is investing in basically social and environmental way that provides a social or environmental benefit as well as a financial benefit. And I would say that we call them social entrepreneurs. It's a growing trend. It's not as common in Canada as the US and the UK, but there was, as I said, 600 people at a conference at Mars last week. And it's another way of doing philanthropy that is an emerging trend.
Now we have 2 more questions, but
I might as well take them now. Yeah, we'll take them now.
Okay. Is there a way for charities to know which donors fund gives to what organization?
So basically, and all donor-advised funds are like this. So when somebody opens a donor-advised fund, there's going to be a question on their application form to say, do you want the charity to know your name, or do you want to be anonymous? And a very small percentage want to be anonymous. So if they have chosen basically to, if they've chosen to have their name and address disclosed, when that charity gets the check from the donor advised fund, they know the name of the fund, they know the name of the account holders, and they have the address, and they're free to cultivate them the way they would cultivate any donor, and maybe even treat them as more important because they know they have a donor advised fund and that they're going to be in a position to give money every single year. So that's how they would know if it's a donor giving to them. Would the charity be able to know about other donors and who they gave to? No, that's not, unless charities are publicizing that. That's private information.
Great. I'll read the last question we
Okay.
have at the moment. Just remind people that they can still submit questions because we'll still have a little bit of time at the end. How would you advise a donor who wants to make an endowed gift versus spending gift over a number of years?
So, I've seen a trend, and first of all, it's a very personal thing. And, the disbursement code rules used to be such that people were kind of forced into endowments. And so there are some people that want they want something to go on in perpetuity. They don't want to touch the capital. They want this to carry on. But I am seeing, and that's great because it's a flow of revenue that organizations can rely on. But I've seen a trend even since we launched the Private Giving Foundation 15 years ago, in that for many people, forever is too long. It's just in perpetuity is too long, and they want to have a fund, and they need to get a tax receipt up front, separate from their granting. But they also want to know that if something comes along that maybe they weren't even aware of it. A project comes along in year 3 or year 4 of their donor advised fund, and they want to take $100,000, and then they want to grant to that project, that that they're able to do it. So I don't say one is right or one is wrong. It's really understanding what the philanthropic objectives and values of of the individual is. And so even with the donor advised fund, with the Private Giving Foundation, like some are wanting it to go on when they're no longer here, some are naming children as successors, and others are basically saying, how do I give you instructions in terms of what I want to happen to this when I die? And for them, it's very simple. Leave a memo with your will, specifying it. If we get a death certificate and a letter from your executor, even though these assets aren't part of your estate, we will distribute it, as per your wishes. So we're not saying things have to be endowed. It's going to be such a personal decision, but I'm feeling the trend of people wanting to create, impact, or excited about some projects they might want to be able to fund, as opposed to just investing the capital and using the earnings. But there are still, good reasons to do endowments. So we've been talking about donor advised funds, and obviously the simple alternative to the private foundation is a donor advised fund. We were the first financial institution in Canada to launch a donor advised fund, the Private Giving Foundation. We're celebrating our 15-year anniversary. The minimum is $10,000, and no lawyers and no setup fees, no board meetings, no administrative duties. It's all done by DAFs. There are lots out there now. Community foundations have been had DAFs for years, and very easy for the donor. That structure of giving, yes, they can be anonymous, but really not too many people want to do that. And it separates that tax receipt from the granting. Very, very easy, very simple. So when do you do a private foundation versus a donor advised fund? Well, it's not necessarily that the millions of dollars go to private foundations and the small money goes to DAFs, because we do have CEOs, past CEOs, people with multi-million-dollar DAFs. Ed Clark, our former CEO, who's publicly disclosed, he wanted something that was tax effective for when he exercised his stock options, but he also wants to pick and choose his charities, and he doesn't want, he doesn't want to go to a board meeting and worry about governance. Degree of family involvement. I would say families get very involved with DAFs, but it's more of an informal meeting, sitting around the kitchen table. We've had people who want private foundations. They have kids or maybe daughters who are age 20 and 21. I want them on the board. I want them to learn about governance. I want them to learn about investment management. And so that's why they're doing that. And so privacy, we've already talked about. The private foundation's not private. The DAF, you can hide a little bit better. But with a DAF, you really can just grant to other charities. With a private foundation, you can charge expenses within reason to that private foundation. So if you're going to go to Whistler and have your board meeting, maybe that would be because your family lives all across the country. Maybe that, part of that trip would be an expense. If you're going to go to Africa to research AIDS projects you were considering funding, that trip could potentially be an expense. But in a DAF, we don't give money for people to jump on planes, or we don't cover any expenses that they would incur to maybe do the due diligence on the charities. The important thing is that if you start with a donor advised fund and then you find that you get to a point where you actually want your own private foundation, certainly at TD, we would help you. We would help you to set up the private foundation, and then we would move the assets from the donor advised fund and to the private foundation. So, and we've actually had private foundations that were set up generations ago, and now the younger generation is too busy to run it, but they want the name to continue, and they want the pattern of giving to continue. So you can roll the private foundation into a DAF also. So lots of different ways to give. We're seeing a big increase in insurance gifts, and giving it to a DAF. So one thing we've seen several this year actually, where you buy the life insurance with the DAF or the charity, the owner and beneficiary, and yes, you get a tax receipt for the premium. So because our clients are working so closely with their investment advisor, when it comes time to pay that premium, and the investment advisor is basically managing the portfolio, they'll look for the stock with the highest gain, donate that stock to the private giving foundation, get that donation receipt, eliminate the capital gain. We sell the stock, but then use the proceeds of the sale to pay the life insurance company the premium, and it can be very, very tax efficient to do that also. So lots of ways to give. The other maybe one last thing. The other thing we're seeing also is new Canadians and immigrants and successful immigrants giving. And our high net worth clients, they don't view the borders of Canada when it comes to their giving. We have successful immigrants who have or giving to their country of origin. They may be building schools in India. They may be working on several projects, and often they're sending after-tax dollars in order to do that. So we try to work with them to see if there's a way to do it more tax efficiently. Charities Aid Foundation has been in the UK for 90 years. They've been in the US, and they got registered in Canada, CAF Canada, as a charity about 6 years ago because they have a very good due diligence process to do the due diligence on international projects. So when somebody wants to do a project outside of Canada, then there's an opportunity for them to have CAF Canada do the due diligence, put a project agreement in place to show that there's oversight and control, and then we're able to direct from the Private Giving Foundation to CAF Canada, who can then fund an international project. So we just literally sent, last week we sent $1.5 million from the Private Giving Foundation to CAF Canada to a hospital foundation in Singapore. And so there was a lot of work involved, but it was great because the client was able to use money he received a tax receipt for to make such a sizable donation outside of Canada, which is not always easy to do. And then we find our clients, our high net worth clients are traveling. And so they travel all over the world, they see something that's not right, and they come back and they want to do something about it. And so that's where we have to start to get creative and see, is there a tax efficient way that we can help them make this gift to whatever international project that they're looking to do. So it's evolving, the different strategies that we're talking to our clients about. So that's the end of the formal presentation. Again, I'll pause and see if anybody has any further questions.
We do have 4 more questions.
Okay.
So the first one is, could you comment on the ability of a donor to pay for an event sponsorship or buy a table with the money in their DAF and their DAF?
So that's a great question because it comes up. We don't know. So it has come up, and so you know that Canada Revenue Agency is very, very strict about personal benefit. And so if you buy a table at an event, you don't get the tax receipt for the full amount of the table. You get it for the full amount less the value of the meal or anything else that you have that you have received during that event. And we have good legal counsel that I have to consult with, and so for our DAF, we only allow it to go where there is a purely charitable purpose and there is no personal benefit. And we have actually said no. So can you donate? Make a donation. Often some of our CEOs will be asked to buy a table at an event, and they can't go or they're not able to go, but they'll make a donation to the event. So totally fine to do that through your DAF, but not to buy a table that, where you're going to be receiving any kind of benefit. And that's the same as golf tournaments, as well as, anything where there's a benefit. And the recent Senate committee report had a big section on DAFs, and we welcome regulation on any of these issues, because there's, it's an area. I go to my lawyer, I say, what do I do? And because we're affiliated with a bank, we have to be absolutely squeaky clean. So we may have some different rules than other DAFs that are not affiliated with a bank, but that's how we have to operate. But we welcome CRA to review this and come up with clearer regulations in terms of how these things need to be treated.
Great, thank you. Now the next 2 questions are pretty much the same, so I'll read one of them. In BC, we have received an update that charities may not accept insurance gifts from donors. This is confirmed by Norton Rose Fulbright, Margaret Mason.
Mm-hmm. So, I know that's a big issue in BC, and I know that Margaret Mason and the Government Relations Committee is looking at it seriously and hopeful that it will be resolved. It's an unfortunate glitch that has come up, but we're hoping that it will be resolved because life insurance is a great way to leave a legacy.
Great, and I'll read the last question, and then after this, if anybody has more questions, they can email you.
Okay.
What was the full name of the agency that worked with the international projects?
The full name of the agency? Okay, so if you Google CAF Canada, C-A-F as in Frank, Canada, one word, that's kind of their abbreviation, and they're part of Charities Aid Foundation. So there's Charities Aid Foundations all over the world, and so they have a good presence here in Toronto. They also have one in Vancouver, and Howard English is the main person in Toronto. And if you have my email, so if anybody wants an introduction or more information, I can email you their website also, and just feel free to get in touch with me.
That's super. Thank you so much, Joanne.
My pleasure.
We'll end today's session here. I just have a few words to mention first. everybody will be receiving an email from me shortly with a link to the recording. In that email, you'll also find a link to the survey about today's webinar, and we really value your feedback. So please take a few moments just to complete it for us, please. Please be sure to register for our next webinar as part of our Webinar Wednesday series. It's on November 27th when Gordon Hawley will present Reading and Understanding Financial Statements of Charities and Foundations for Gift Planners. Please see our website for registration details. And also, the next Original Canadian Gift Planning course is taking place in beautiful Quebec City, February 24th to 28th, 2020. Registration is going quite well, so please be sure to register sooner than later if you're planning to attend. And I do have one last announcement before we end things off for today. Later today, registration will open for CAGP's 27th National Conference on Strategic Philanthropy. The conference takes place April 22nd to 24th, 2020 in Regina, so we hope to see you there. You'll find more information on our website, and of course, don't hesitate to reach out to me with any questions about any of these things anytime. Joanne, I want to thank you so much for sharing your expertise and knowledge with us today. Really appreciate it very much.
My pleasure. Great to be here. Thank you for having me.
Thank you. Have a terrific rest of the week, everybody.